Welcome everybody. Good afternoon. This webinar is Match Made in Heaven, Understanding the Economics of Integrated Crop and Livestock Systems. I'm Jane Jewett from the University of Minnesota. And next slide, please, Laura. And I'm with the Greenland's Blue Waters Initiative, which is a multi-state research and education and outreach consortium devoted to continuous living cover in agricultural systems, which includes a number of strategies: agroforestry, perennial biomass, perennial forage, perennial grains, and rotations that keep the ground covered 100% of the year. I coordinate the Midwest Perennial Forage Working Group, so perennial forage is circled there. We are the group that is leading this project, and we really like perennial forages and grazing and livestock, but we also work on grazing cover crops and some silvopasture. Next slide. This project was funded by an ERMI grant, Extension Risk Management Education, from the North Central region, and underwritten by the USDA's National Institute of Food and Agriculture. Greatly appreciate the funding. Next slide. And here's our project team. So myself, we have Laura Payne with us today, Wisconsin Grazing and Livestock Specialist. Jennifer Lutz will be a presenter with University of Missouri Extension. Gabby Bulwark will present. She's with University of Minnesota Extension. Jason Cavadini with University of Wisconsin Extension and Margaret Chamis with Practical Farmers of Iowa are both on our project team. And today we also welcome Paul Dittman with Compeer Financial, who is going to give us some insights with a lender's eye on our data. So thank you all. Next slide. And I am going to turn it over to Gabby Bulwark now to get us going.
Yeah, so to sort of kick us off in thinking about why we might integrate livestock in the first place, I think it really makes a lot of sense when you think about it from a soil health perspective. I've got the 5 soil health principles here, and integrating livestock is indeed the last one, but it is one that folks tend to adopt either later or not at all. People tend to do things like keeping the ground covered or minimize soil disturbance, maybe earlier on in their journeys than integrating livestock. But integrating livestock has a lot of potential to make big changes in soil health in a potentially shorter time period than if you were to do just a couple of some other practices that hit the other soil health principles. Next slide. And so when we think about integrating livestock, what we're really doing is adding more diversity to the landscape, this, in the form of livestock. And when we have more diverse systems, those systems tend to be more resilient. So if you work through kind of a mental exercise here, when we add diverse crops and livestock to a farm, it can increase the soil health, as I had mentioned. When we increase soil health, that also improves water regulation. That is both, drainage or infiltration and water holding capacity. When we improve soil health, we can improve water regulation in both of those ways. When we have better water regulation, we can increase the resilience to extreme weather. So sometimes we've been experiencing, really heavily, a lot of rain in the summers, or maybe sometimes we'll be having droughts. So with the improved water regulation, we're a little bit more resilient to those extreme swings, which therefore leads to maintaining crop yields and sales in some challenging weather years, which is really what it comes all down to. We have to pay the bills, we want to make a profit. So if we can keep crop yields in those challenging weather years, that's awesome. So that's sort of a why for livestock integration. Next, please. that kind of leads us to our project question, which is why we developed this ERMI project, which is, does crop and livestock integration equal financial resilience? You know, maybe it equals environmental, but we wanted to take a deeper dive into the finances. So now Laura will give you a little bit of background on a different but related project.
Yeah, so the genesis of this financial project was a 3-year project that we just wrapped up last year, that was looking at livestock integration much more broadly. In the map on the right side of your screen, you can see this is the Upper Mississippi watershed, and the yellow on the map is annual cropland. So looking back at those soil health principles, we have a lot of farms that don't or aren't able to integrate livestock and are currently focusing on annual cropping systems. So we really wanted to look at, where are there farms that are still integrating livestock, and what kind of practices are they doing? So the centerpiece of our project that we just completed was a big survey that we conducted in 2023. We had around 550 responses, 25 states represented. Among those farmers, the average age was 49 and average years farming, so it was 2020 or 23. So these are kind of mid-career farmers that were doing a lot of this. The average acreage was about 260, or excuse me, a little over 500, 260 owned and 251 rented. So we're not going to go into a lot of detail on this survey, but I did want to point you to the Match Made in Heaven website, which has survey summaries of these data. We've got all respondents, we've got some summaries by state. We've also broken them down into beginning farmers and experienced farmers, and also integrated farms versus crops only farms. So those are there for people to take a look at. So what did we learn about these farms? One of the things was that for the vast majority, both livestock and crops were produced on these farms, 457 out of the 557. And we did have about 40 farmers that had only crops in their systems. As far as primary sources of income, on the right here, about 2/3 or 3/5 of the farms indicated that livestock was their primary source of income, and then another third or so said that grain crops were their primary source of income. So they were pretty fairly well balanced between those two enterprises in terms of income streams. When we look at the practices that they use that kind of make these farms unique, we can see that a large majority of them use managed rotational grazing to get the most out of their forage crops. They also did things like grazing crop residues and grazing cover crops, and grazing summer and winter annual crops. So these are some of the unique things about these integrated farms, where they're really using the cropland to produce feed for their animals in a lot of different ways, including grazing the crops on those land. The other thing about this that I'd like to point out is the difference in colors here. The blue parts of each bar shows farmers that have been using these practices for now well over 5 years. But the interesting thing is the green parts of the bars, which is people who have adopted these practices fairly recently. So livestock integration is kind of catching on here among crop farmers, and they're using their cropland in ways that they haven't in the past to produce livestock feed. Okay, and so we asked these farmers also what benefits they had seen from integrating livestock in their systems. And you can see the majority of responses fell into the categories of using manure as fertilizer. And then here's our soil health information, or the thought of improving soil health was a big one, over 60%. And a lot of these farmers felt that they were improving their conservation outcomes on their farms. But this current project is really looking at some of these financial indicators. So I've got those circled in red here. They did see almost 50% indicated seeing a reduction in feed costs. They appreciated diversification of income streams, and a smaller percentage felt that it reduced financial risk. So the farmers who were integrated did see quite a few benefits. They also saw some challenges, but one of the interesting questions that were answered by this was whether the challenges are the same for the crops and livestock farmers. And this graph shows that crop farmers see some challenges because of their inexperience with livestock, that livestock farmers don't see as being as great. So the yellowed bars here are the responses from those 40 crops only farmers on the things that they felt were challenges to adopting livestock into their systems. And the green bars are what were most challenging from the livestock farmers' perspective. So we have some challenges and we have some benefits. This project is really going to look at a couple of questions related specifically to the financials. So we wanted to find out whether there are efficiencies gained in integrated systems that can save farmers money. So cost of production questions, fertilizer, ag chem, that kind of thing. And then we also wanted to look at long-term profitability or financial resilience benefits. So those are the two questions that we'll be answering today. We're going to do that using a data set that we collected over the last year using financial data from 2024. We input these data into the University of Minnesota FinPac framework. We ended up with 11 integrated crop and livestock farms from 4 states in our little data set. The average size was almost twice as large as the farms from the previous survey, about almost 1,000 acres. You can see they're split between crops, hay, and pasture. And then we took those farms and compared them with crops only or cash grain farms from the same data set. And we used the same states and the same size range of acres. And that was approximately 610 farms in that data set. Now I'm going to turn it over to Jennifer to tell us what we found.
Yeah, thanks, Laura. So I just wanted to take a quick minute to touch on what FinPac and FinBen is. So FinPac is a farm financial planning and analysis program. Really allows us to look at the income and expenses and evaluate those and really drill down into what they are. Allows us to assess the profitability. We can use them to develop cash flow projections, even though that's not a piece that we used in this project. And ultimately evaluate the financial impact of different enterprises on the farm. From there, we transitioned over to FinBen, and FinBen is a database that kind of culminates all of the different FinPac farms and kind of provides us a financial benchmark that we can use to compare our farms against. And so, next slide, Laura, as we go through the categories and the different pieces of what we pulled out of our 11 farms in FinPac, you'll see the crop and livestock on the right side of this chart. That'll be kind of what we'll see as we go through. And the crops only is the FinBen data of those 620-ish farms from FinBen that were crops only out of the 4 states that we utilized. And so as we look through this, we'll take a look at income and expenses and kind of an overall for these two different farm types. And some of the things that I'd like to point out here is, our crop only farms only had crop income. And so their crop income was a lot higher than our integrated farms. And keep in mind that all of the acreage of our integrated farms is inclusive of crops and livestock and, the hay pasture land. And so as we look at crops for our integrated farms, only about a third of their acreage comprised crop on it. So we expect to see the crop income lower on our integrated farms on a per acre basis, because we're really only including about a third of the income for all of the acreage. So then we add in the livestock returns, our crop insurance revenue, hedging and other income, and our government payments. Keep in mind, our hedging and other income includes the hedging, any custom work that these farms are doing, any patronage or sale of resale items, maybe some livestock insurance or farm rental income and things like that. Our government payments really included those crop government payments, conservation payments, and any livestock government payments that they may have from the government. And so with that in mind, we look at these two different farm types, and we can see that our integrated farms have about $50 more gross income than our crop only farms. Also keep in mind that this data is from 2024, so this is a 1-year snapshot comparison of these two different farm types. Go ahead, Laura. So we get into the bottom line, right? So we have got our gross income at the top. We've got our 4 categories of expenses as we move through there, our total expenses, and our net return at the bottom. And really what we're looking at here, those total crop expenses are running about a third on the integrated farms on a per acre basis. Again, to be expected, they're using about a third of their acreage for crop production. Livestock expenses are an additional cost to the integrated farms. The whole farm expenses and overhead expenses, it's a little difficult looking at it this way to tease out which farms are doing better if we combine those. But the crop and livestock integrated farms are using a little less overhead and whole farm expenses. So we can see that total expense, we're about $70 difference on the total expense, with the livestock integrated farms having a little less expense than the crop only farms, providing that net return of $7 to the crop farms and about $120 to the integrated farms. Next slide. So as we break down, we really wanted to know, are there efficiencies gained in these systems on the crop production pieces of it, fertilizer, the chem costs, those sort of things. And really what we found out is that we don't really think so. And so we can see some of these things here. We've got on seed costs, we've got about $32 per acre on the crop and livestock farms to $90 on the crop only farms, which makes sense because 32 is about a third of the crop only cost. So those all are kind of in line with what we expected. And same with that total, about $105 to the 300, again, about a third. And so while the integrated farms did have lower input costs, they were using less acreage to do so. Next slide, Laura. So we look at the livestock farms, at those kind of cost categories unique to livestock farms. And one thing that really stands out here is that feeder livestock purchase. We did have a few farms that we were looking at that were buying feeder cattle and feeding them on their farms and finishing them on their farms. And so that was a lot of the expense here on the cattle and livestock farms that not all integrated farms would have. So we do see that purchase feed, the veterinary expenses, supplies, bedding, so on and so forth, to that tune of $181. Next slide, Laura. And I really wanted to bring the labor expenses out because this is somewhere we really did see a difference in these farms, and where the integrated farms had higher expenses than our crop only farms. And some of this makes a bit of sense, as you'll see in a little bit with depreciation. The crop-only farms really had higher machinery costs, and the livestock farms had higher labor costs. And so there's a bit of a trade-off here that I think is happening between these two different farm types. The other big consideration is that when we integrate livestock, so crops, a lot of the work happens in, spring, summer, fall. When we add that livestock component and we're doing some winter feeding of livestock, we really increased our winter labor hours. So while there is some differences here, it's not too shocking. Next slide, please. And here's where you see some big difference on the crop only side. At first, we were a little shocked to see that land rent so high on the crop only side, that they were spending so much money on a per acre basis. And then I got to thinking about some of the things we do. And then I'm like, wow, that actually really does make sense. Because our tillable cropland, when we rent it, does rent for a higher dollar amount per acre than our pasture and our hayland does, our permanently planted fields. And so seeing those differences, that really makes a lot of sense. A lot of our integrated farms were producing crops on land they owned and renting out pasture or hayland to supplement their acreages. The other big key thing here to take away is the depreciation and interest. Like I was talking about before, it seems like the crop only farms have a bit higher machinery costs that are still out and financed, where the integrated farms really do not. And so we're seeing those total costs due here on these two farms becoming quite different. Next slide, please, Laura. So back to our overall big picture here and our total income, total expenses. When we add up the whole farm expenses and the overhead expenses, we can see that there's about a $50 difference there, that the integrated farms are saving about $50 compared to our crop only farms. So we add that $50 to the $50 additional in income, and the savings that we get of about $20 on their total crop livestock expenses. And that brings us to that $128 net return. Okay, next slide, please, Laura. So are there efficiencies gained in the integrated system that can save farmers money? Ultimately, yes, there are efficiencies, but I don't think they're what we thought they were. We didn't really find those efficiencies in that fertilizer and chem costs and those crop costs, but we did find it in that whole farm expenses. When we, sorry, I've lost my thought. When we looked at the long-term profitability benefits, we can't look at that with just 1 year of income and expenses. Anybody that's in agriculture knows that in 2024, we didn't have very good crop prices. We did have pretty strong livestock prices. And so to help us really look through that and to get a better understanding of how these farms might look long-term, Jane really looked at a sensitivity analysis using a partial budget tool to see how changing prices really would affect these farms. I'll pass it over to you, Jane.
Yeah, thanks, Jennifer. So the partial budget analysis, I used a framework that was developed at Iowa State University, but then modified it for this project. So we're using just cash income and expenses and splitting that up between the crop and the livestock enterprises. So some of the other farm income, for instance, that couldn't be allocated directly to either crop or livestock isn't in this analysis. If it was crop insurance income or livestock insurance income, that was pretty clear how to allocate it. But this is really looking at just the crop and livestock enterprises, not depreciation, not assets. It's stripping out all of that. And it's using only 7 of the farms in the study that I had really good data on the breakdown of acreage for those farms because the calculator depends on that. So next slide, Laura. I think this is one of those animation ones. Yeah. So with the partial budget, there's a gains side and a losses side, and it's set up in quadrants. So there are direct gains and direct losses from adding the new enterprise. And in this case, that is a livestock enterprise overlaid on a crop farm. And then there are, on the gain side, costs avoided because of the new enterprise, and on the loss side, potential income loss due to the new enterprise. And then obviously, if it's greater on the gain side, it's a net gain for the farm, and if it's greater on the loss side, it's a net loss. So next slide. Here's the composite farm example that we used from those 7 farms. So approximately equal corn and soybean acres, some winter wheat acres, hay, other crops, and then quite a bit of pasture acres. And for these farms, a fair amount of that was rented. And then again, like Jennifer mentioned, this is a snapshot with 2024 pricing. So crop prices, on the lower side, and feeder calves at $270 a pound, and bred heifers at about $3,300 a pound. Next slide. I mean, $3,300 a head, sorry. Okay, so here is what those quadrants looked like. And Laura, you can go ahead and click through to the next slide to show all the quadrants. So direct added income and added costs on top, and then on the bottom, kind of looking at those synergies between crop and livestock enterprises, where you have the value of the manure as the fertilizer, the value of soil retained and not lost to erosion on acreage that's not row cropped, and then income not realized when you're feeding grain and hay to animals instead of selling it. And then opportunity cost of crop sales that are not made on crops that are not grown on tillable acres that are in perennials. So next slide. So here's the bottom line on that composite partial budget analysis. We're looking at a net gain on the livestock enterprise of about $84,000. A net loss on the crop enterprise side of about $30,000. And that's because, partially at least, a lot of the crops were being fed to the livestock instead of sold. The net gain of the combination of the two is $52,775. And we'll see that number again on the next slide. Next slide after this one. So a sensitivity analysis is a way to look at how this is affected by the changes in crop and livestock prices. Because again, this was a snapshot of 2024, and things are going to look different as those crop and livestock prices change. And we have seen a fair amount of volatility in that over the past several years. So next slide. Okay, so there in the center is that $52,775 figure. That was the combination of crop and livestock enterprises net income. And then that's with the 2024 corn and soybean prices there in that column. And the row is the livestock prices. So $270 a pound per head of feeder calves. That worked out to about $1,900 per head over all classes, which included some sale of bred heifers. So as those crop and livestock prices change, then you can see how the profitability of the farm shifts from profitable in the green down to unprofitable in the red if both crop and livestock prices are low. Next slide. Yep, and so the 30-year average prices of corn and soybean, $3.64 corn and $8.97 soybean per bushel. So inside that red box is where the historic long-term average of crop prices would be. And so you can see there that the farm remains profitable with livestock included, as long as livestock prices don't drop more than about 10% below the 2024 price. Next slide. But then the question is, are livestock a net benefit or a drag on the overall farm cash income, which you can't really see with just the combination of the two enterprises. So here is where the farm with combined crop and livestock enterprises is compared to a hypothetical farm where all tillable acres are planted to row crops and all cash crops are sold. And when we do that comparison, then in the purple is where the livestock farm, the farm with both crops and livestock, the integrated farm, is clearly more profitable than the hypothetical of if it's all cash crops, all crops sold. So that's where livestock really shine, is when crop prices are low and livestock prices are relatively high. Next slide. And then this slide kind of puts it all together and shows, where the farm is profitable, where it's unprofitable, where the farm with livestock is more profitable than it would be if it was all cash crops sold, and where the farm would be less profitable, where the farm would lose money and lose more money if it has livestock than if it doesn't have livestock. So, you can see that there's quite a bit of green on here. The farm with livestock is profitable over a pretty big range, where the farm with livestock exceeds the performance of the hypothetical all cash crops farm is again when livestock prices are at 2024 levels or higher and crop prices are relatively low. But there's also quite a bit of space in there at higher crop prices where the farm with livestock remains profitable, and you're giving up some potential income that you would gain if everything was tilled up and in cash crops. But there is space there with the livestock present to do some other things that may be goals of the farm, like, for instance, adding a next generation with a livestock enterprise to come in and start building equity on that farm. Okay, so that sets up some more discussion, I think, from Jennifer and Paul. Oh yeah, there's that historical long-term average crop price. Yep. So looking long-term, again, are there long-term profitability benefits associated with those diversified systems if you've got both crop and livestock enterprises generating income? And Jennifer, I think we go back to you.
I think we're kicking it over to Paul now.
Okay, great. Paul.
Yeah, I believe so. Well, hello, everybody. Paul Dittman. I'm with Compure Financial, which is part of the Farm Credit System based in Wisconsin. So some of the indicators of longer-term financial health, we can use what's called a farm finance scorecard to kind of get a snapshot of financial health. And there's this farm financial scorecard is a tool that was developed by University of Vermont Extension a number of years ago and takes 21 financial ratios that are recognized by the Farm Financial as sort of the key numbers that we look at when we're evaluating the financial strengths and vulnerabilities of a farm operation. The Farm Financial Standards Council is something that grew out of the farm crisis of the 1980s. It's a group of professionals, it's university professors, it's accountants, it's lenders, it's government officials that all came together after the farm crisis and tried to come up with one set of financial standards that all farm lenders can pretty much use. And not just farm lenders, it's really for anybody who's working with farmers, trying to help them assess the financial strengths and weaknesses of their operations. A statement of cash flows, we're going to go through a statement of cash flows for the livestock farms that are in the study. Just another way of looking at assessing financial health. It's a tool that really is used a lot. If someone's in serious financial trouble, we can take a look at that statement of cash flows, look at where cash is being generated, where it's being used, and try to hone in on the areas of the farm that we might want to focus on. and try to improve the financial management. So next slide. Excuse me. So this is the first part of the Farm Financial Scorecard, and this is looking at measures that come from the balance sheet. The balance sheet is a listing of all the assets, all the liabilities in a farm operation. We measure liquidity. That's just looking at the short-term debt, or short-term assets and short-term liabilities. The first number that we're going to look at here is the current ratio. Current ratio is taking the total current assets, and current assets are cash, anything that could convert to cash, anything that will be used up on the farm within a year's time. So it's checking account balances, it's crop and livestock inventories, it could be crops growing in the field, that sort of thing. Anything that's prepaid expenses, anything that's going to be used up on the farm or turned into cash or is already cash. We take the current assets, we divide by current liabilities. That's anything that's due now or that's going to come due within the next year's time. And the current ratio, we just take current assets divided by current liabilities. So the crops only farms, the current ratio 2.11. That's actually not a bad current ratio. We generally figure 2 or better is a pretty decent current ratio. That's saying that you've got twice as many current assets as you do current liabilities. If we got down to less than 1, it's saying that if you had to pay all of your current liabilities today, you couldn't generate enough cash within the operation to pay everything off. So 2.1 is pretty good, but you look over at the crop and livestock farms, almost 6. So almost 6 times as many current assets as they have current liabilities. So that's very, very strong. A thing that we look at as lenders is the working capital to gross revenue. So working capital is current assets minus current liabilities. It gives us a dollar figure. We want that dollar figure to be at least 15% of the farm's annual gross income. So if the farm is grossing $100,000 a year, we'd like the net working capital position to be at least $15,000. So anything above 15% we consider to be pretty strong. So both the crops only farms and the crop and livestock farms have pretty strong working capital positions. So these are farms that have a lot of current assets relative to current liabilities. And relative to their gross income, I should say, their gross annual income. And then working capital to operating expense, we don't really look at that very much, but it's saying they're very strong. Both farm categories are very strong there. The other measure that we look at here is solvency. So the balance sheet can be used to calculate liquidity and solvency. Solvency looks at the overall balance sheet, all of the assets, all of the liabilities, and then we run some ratios. So farm debt to asset ratio, so that's taking all the farm debt and dividing it by all of the farm assets. The crops only farm, they're at about 38%. The crop and livestock farms are at about 14%. So it's saying they have about 14 cents, the crop and livestock farms have about 14 cents of debt for every dollar of assets employed on the farm. And the crops only farms have a higher level of debt. The equity to asset ratio is just the flip side of the debt to asset ratio. It's taking the farm liabilities, or taking the farm assets, subtracting the farm liabilities gives us the owner's equity position, and then dividing that by the assets. And so crops only farms 62% equity to asset ratio. The crop and livestock farms, because they have very little debt, they have a lot of equity, that's 86%. And then the debt to equity ratio is just taking the debt divided by equity, 61 or 0.61 on the crops only farms, 0.16 on the crop and livestock farms. So the crop and livestock farms just have much less debt compared to the crops only farms. Next slide, please. So the next category that we look at from that farm finance scorecard is profitability. And profitability, you can think of this as looking at the net return from the farm operation, and then looking at the investment of dollars that we have tied up, both in assets and then the equity position that we have on the farm. So we look at really both of these numbers, rate of return on farm assets, rate of return on farm equity. The percentage there should really be higher than the cost of borrowed money. It's like right now, interest rate on farm loans is going to be in the 7% range, plus or minus, depending on the length of the term of the loan. So we really, if we're going to take on any debt in a farm operation like this, we would want to achieve better than a 7% rate of return on equity. So you can see really in neither one of these categories are we achieving that. And that's not unusual. You know, when we value farm assets at their fair market value, especially with the way that land values have gone up in the last 5 years or so, here in the upper Midwest, land values have gone up 45% in 5 years, just since 2020. 45% increase in land values in that period of time. So it makes it that much more difficult to achieve a reasonable rate of return on assets and rate of return on equity, because the assets just became a lot bigger on the balance sheet, even though we didn't really necessarily do anything to create that value. Just the market gave it to us. So the rate of return on farm assets for the crops only farms, negative 0.4%. Rate of return on farm equity, negative 3.4%. So it's saying these farms are really unprofitable. Now, most of the time, most people aren't sitting down and figuring out what the profitability is, because they're not really going to do anything about it. You know, they're not going to sell their farm and go invest in stocks or whatever. They're in it for the long run. And so they're not necessarily looking at what the profitability is. Where it comes into play, though, is if you're transferring these assets to the next generation. If the farm's been unprofitable, there's no way that those assets can transfer at fair market value to the next generation and have them make a go of it. We get closer on the crop and livestock farm. You know, rate of return on farm assets is a positive 3.3%. Rate of return on farm equity, a positive 3.5%. So at least we're on the plus side of the rate of return instead of a negative. In this year, 2025, I mean, it remains to be seen. We still have a few months to go, but it looks like on the crop side, things are going to be really, really tough this year, and possibly even tougher next year, depending on what happens with markets. On the livestock side, we've had great prices. It looks like those are going to continue for a while. So this 2025 could be an even stronger year for the combination crop and livestock operations. Operating profit margin, negative on the crops only side, positive 20% on the crop and livestock farm side. And then asset turnover ratio, which is kind of a way of looking at how efficiently we're employing the assets in the operation, like how much revenue are we generating relative to the amount of assets. Both pretty low, with crops only at 26.2, and crop and livestock at 16.3. Next slide, please. Repayment capacity. So this is all about cash flow, and this is where lenders tend to focus a lot of their attention. And in particular, we look at term debt coverage ratio and the replacement margin coverage ratio, which is the two lower ratios in this template here. Term debt coverage ratio, it's saying, are we able to cover all of the term debt after we've already paid for operating expenses, for family living costs, any tax liabilities, all those sorts of things. So do we have enough cash left over to make the principal and interest payments on our loan? We want to see that at least 1. In fact, really where we'd like to see it is 1.15. On the crops only side, 0.64. So that's saying they're not generating enough cash flow from these farm operations right now to even cover their term debt, be debt on machinery, debt on breeding livestock, debt on real estate. The crop and livestock farms, though, at 7.75, that's really, really strong. Again, we want 1.15 or higher, and they're at 7.75. So that's a very strong number. It's saying that they can very easily cover their debt load. Of course, we said earlier, the crops only farms have significantly more debt than the crop and livestock farms do. So with better cash flow, better profitability on the crop and livestock farm, combined with lower overall debt, they're finding it much easier to handle the debt that they do have. And then replacement margin coverage ratio, this sort of takes that term debt coverage ratio and adds a few more demands on the farm's available cash. It looks at if there was a working capital deficiency, and we saw there wasn't a working capital deficiency for either category of farms. But if there was, we would want to build that in as a demand on cash and include that in the replacement margin coverage ratio. The other thing that we plug in there, because we're really looking at cash flow here, we also, and we've ignored depreciation, we also want to factor in, well, how are we going to replace the stuff that's rusting and rotting and wearing out on the farm? So if you've got machinery, that's going to have to be replaced at some point. If you've got buildings, at some point you're going to have to replace the roof, that sort of thing. We're going to build something in as a capital asset replacement number and plug that in and calculate it as part of the replacement coverage ratio. Again, on the crops only farms, they're not even coming close. And again, we want that to be 1.15. So they're at 0.5, they're way, way short. Crop and livestock farms, very comfortable, 3.58. So this is saying the cash flow, and there's a difference between cash flow and profitability. It's saying the cash flow from the crop and livestock farms is significantly better than the cash flow from the crops only farms. We saw the profitability was higher too. Profitability and cash flow are related to each other, but they tell you very different things about the farm operation. So the cash flow is very, very strong in the crop and livestock farms. Next slide. Financial efficiency, it's a little bit tricky to try to make a comparison from crops only farms to crop and livestock farms. Financial efficiency ratios generally are used to compare somewhat similar enterprises against each other, or the same enterprise from one year to the next, and how these numbers change. These numbers, these four categories, operating expense ratio, depreciation expense ratio, interest expense ratio, net farm income ratio, they should add up to 1. And it's essentially taking the gross farm income and then breaking that out into these 4 different categories. What this is telling us, operating expense ratio for the crop and livestock farms, I'm going to mainly focus on them because that's the main focus of the webinar today. 0.69 is okay. You know, it shows up in that moderate section. I think it's not a bad number. It's you know, compared to 0.84 on the crops only farms, saying that the crops only farms have a lot of expenses relative to their gross farm income. Crop and livestock farms, not nearly so much. You go down the line, depreciation expense ratio at only 0.02. It's saying that they don't have a lot of depreciable assets tied up, relatively speaking, in the crops and livestock farms. Interest expense ratio at 0.01. Again, that's pointing to the fact that they just don't have much debt. So they're not using much of their income to make interest payments, only a penny out of every dollar that they generate. And then the net farm income ratio, it's saying that they're keeping 28 cents out of every dollar as net farm income, whereas the crops only farms are losing a penny for every dollar that they're generating in revenue. Next slide. Statement of cash flows, and we only have a statement of cash flows for the integrated farms, the crop and livestock farms. Again, this is a way of looking at how cash flows through the operation during the year. And we break it into 3 different categories. Cash provided by operating activities, so that's the operation of the farm. So that's cash coming in, cash going out for operating expenses. So it's only looking at the operating activities. Cash provided by investing activities, that's investment in capital assets for the farm operation. So it's purchasing equipment, it's purchasing land, vehicles, things like that. And then on the flip side of that, selling those sorts of assets. So are we selling off machinery? Are we selling vehicles? Cash provided by financing activities, that's loans that are providing cash inflow to the operation. It's also loan payments that are taking cash out of the operation. And we also, in this segment, include non-farm income, and we also include family living expenses, because with a farm enterprise, we figure that any income that's coming into the farm, even from non-farm sources, is a source of financing for the farm operation. And then taking family living expenses out, that's taking something out of the farm operation. So to read the statement of cash flows, we start with the beginning cash balance. So this is saying on January 1st, the average farm had about $93,000 in cash. The cash provided by operating activities was a positive $137,542 during the year 2024, which is fantastic. I mean, that's great. Cash provided by investing activities, it's saying that they're putting more cash out to make investments in the farm than they are in selling off capital assets to provide cash to the farm operation. So that's a good sign. It's saying that they're reinvesting in the business. And then cash provided by financing activities was a negative $35,000. So that's saying they're not taking on a bunch of extra debt to plug into the farm operation. They're actually paying down debt. The net change wasn't a whole lot over the year. It was only $872. So they started the year with $93,115. And actually that number should add up there. So we might have a math error there someplace, but ending cash was $90,119.
There are some discrepancies that I didn't list on there.
Oh, okay. We're close.
We're close.
Okay, next slide. So here we're just digging into that cash provided by operating activities. So the average gross cash farm income from the integrated farm operations was $755,807. Their total cash farm expense was $618,265. So they generated $137,542 of operating income. Next slide. Gets a little bit more detailed in the investing activities. So we'll start on the left-hand side. They sold some breeding livestock, $23,428. So it's a positive number because it's cash that came in that became available to the farm operation. They sold some machinery, $3,675 worth of machinery on average. Sold some other farm assets. I'm not quite sure what those would be. We go over to the purchase category. They purchased breeding stock of $10,992. It's a negative number because it's cash that left the farm operation. Purchase of machinery and equipment. They bought $24,431 of equipment to probably replace that $3,675 of old equipment they sold off. So they're making a positive investment in the farm operation by purchasing machinery and equipment. They purchased some land, $30,000 worth of land on average, took cash out of the operation, so that's why it shows as a negative number. Purchase of buildings, titled vehicles, negative $76.96. So again, that's cash that left the operation, purchased those buildings and titled vehicles. And then purchase of non-farm assets, I'm not quite sure what that would be, but negative $55,357 that left for purchase of other assets. So they're purchasing a lot more stuff than they're selling off. This is a place, if they had negative operating income, we would look here and we say, okay, well, they were losing money on the operating side. What are they doing to make up for it? Are they selling off their machinery? Are they selling off land? Are they selling off breeding stock and not replacing that stuff? You know, that would be a red flag. But we're certainly not seeing that. Next slide. Cash provided by financing activities. So again, on the left-hand side, money borrowed. They borrowed $108,817 of new money, but they made principal payments of $107,480. And then they had some income tax and social security liability that they had to pay $35.79. So this is saying this might be an operating loan. They might be borrowing $108,000 on the operating loan and then paying $107,000 back. So they're cycling dollars through the operation. They're not just borrowing money and not paying anything back. That's a good sign. Personal income, so they had some off-farm income, $24,000 on average. They took out some money to live on, family living withdrawals of $22,333. And then they made capital distributions from their farm operations on average, which you can sort of think of as another way of covering family living expenses. So they took a capital distribution. So $35,731 left the farm operation in that manner. And then they received some gifts, $909, but then they also gave some gifts, $422. But the bottom line is there was they paid out $35,725 more than they took in from borrowing money or from off-farm sources. So that's again a good sign. It's saying that they're taking care of their debts and you know, not borrowing a lot of money to try to afloat. They're actually pretty well. Next slide. So, and this is going back to that first slide that we started with. Of beginning cash, brought a lot in from operating activities, put some money out to reinvest in the farm, and then we paid down some debt, and ended with still a fairly strong cash balance of $90,000. Next slide. And then this, Jennifer, I think this is yours, right?
Yeah, unless you want to have some just kind of follow up from that cash flow and how we look at long-term profitability of these farms.
Yeah, if anyone has any questions, feel free to either put them in the chat box or it's a small enough group. I think you just asked.
Yeah. So thank you, Paul. We can go to one more slide. So I had one more thing I wanted to touch on before we kind of wrap up this, and I know we're pushing our time here. But if we think of these integrated farms as diversified farms, and our crop-only farms as specialized farms, there's one real big challenge of really thinking about diversification and maintaining diversification on our farms. And that really is that one enterprise, whether it's the crops or the livestock, they will be less profitable than the other. And that really pushes our farm workers, our farm managers, our farm owners towards the idea of specialization because they can make more money in 1 year with one enterprise. But I want to challenge people to think about the trade-offs between long-term risk reduction and short-term perceived economic loss, right? So we see that net profit not being as high when we have both as a loss. And so I want to challenge us to think about that in a different way, from the short run and the long run, and really differentiate those thoughts. Next slide, please, Laura. And so we'll go back to Jane's partial analysis. And we saw these two charts earlier, and that top chart is really looking at what would happen if we had the livestock farm versus our crop only farm, right? And you can see there's a lot of negative numbers on that chart. And so what we're saying is across a lot of that time, if we have both the livestock and the crops, we're not going to make as much money as we did with a crops only situation. But that's really what I want you to think of as a short run analysis. And if we look to that bottom chart, we can see that in most of this chart, overall, the farm is making money with both crops and livestock. So all of those ones and twos that you see that are not negative, those are positive returns to the farm. And what's really stands out here to me is that even though we're not making as much money as we would on a crop only farm when we integrate livestock, the livestock is really saving our bacon when crop prices are low, right? And so that's that long run farm viability that diversification offers versus that top one, that short run, short term profitability. And so I really just wanted to take a minute to point out kind of the elephant in the room is that we are always tempted to specialize when we just look at the short run, because in the short run, specialization makes sense. It's the long run where diversification really starts coming into play. And like Jane mentioned earlier, bringing those other generations back to the farm and having another enterprise to help spread the finances out to cover more families on the farm. So, Jane, I will kick it back to you.
All right, thank you. So this is grant funded and we do have to do grant reports. So if folks could take that evaluation survey, we would appreciate it very, very much. And I will throw that Z link into the chat as well to make it a little easier for folks to access that survey. And then we're going to move into conclusions here. Laura?
Yeah, so we covered a lot of territory here, but I think what we've learned in the last 4 years as we've been looking at this topic is that these integrated crop and livestock systems are pretty complex and each farm is unique. They're highly varied, but we did see a lot of evidence that the income and costs are diversified across the enterprises. For the farms in our study, we found that gross income was higher and costs were lower compared to a crops only farm, yielding a significantly higher net income per acre. And as you heard from Paul, a lot of the financial benchmarks do suggest that for these integrated farms, they can be more financially resilient. But just ending by pointing out that as we think about livestock integration across the region, there are some challenges to helping crops-only farmers transition to adding livestock. And as we mentioned, some of those included finding processing and markets. The whole topic of livestock infrastructure is a place where we as educators and lenders can help farmers add that to their systems. Labor was a big issue, much higher on the livestock farm, so that's another challenge that we have there. So all in all, I think there's a lot of potential here, and there's also a lot of challenges to helping farmers make those transitions. Okay, and that wraps us up here. And any discussion from the group? Any questions? You can put them in the chat, or you can just unmute and ask them.